There's this moment, and honestly, I think most people who are serious about retirement have experienced it, where you open up your brokerage account, look at the number sitting there, and feel two completely contradictory things at the same time. Pride, because you worked hard to get that number, and this quiet, creeping anxiety because you suddenly realize you have absolutely no idea if it's actually going to be enough, or how to make it last, or whether the way you have it structured right now is secretly working against you in ways you can't even see yet. That moment, that weird mixture of I've done something right and wait, do I actually know what I'm doing, is kind of what I think about all the time. My name is Josh, and I spend way too much time thinking about money, the psychology behind financial decisions, and why some people manage to turn a modest retirement portfolio into something that genuinely sustains and even grows throughout their entire retirement, while others, people with similar numbers, similar life circumstances, slowly watch the same portfolio erode in ways they never expected. And here's the thing I've noticed, the thing that keeps pulling me back to this topic. The people who get it right almost never do it in a flashy way. They're not timing the market. They're not rotating into whatever sector is hot this year. They're not sitting in front of multiple monitors watching ticker symbols. They're doing something much simpler, much quieter, and honestly, much more effective. What I want to talk about today is a specific ETF strategy, a way of structuring and selecting exchange-traded funds that keep showing up in the portfolios of retirees who genuinely seem to have this figured out. Not in the sense that they never worry about money, but in the sense that their portfolio is working for them in retirement rather than just slowly being consumed by it. It's not complicated, but it is specific. And by the end of this, you're going to see your own portfolio and maybe your whole approach to retirement income a little differently than you did before. Let me start here because I think there's a foundational misunderstanding that most people carry into retirement, and it quietly shapes every decision they make after that. The misunderstanding is this, that the job of your portfolio in retirement is basically the same as it was during your working years, which is to say, grow, maximize return, pick the best performers. The framing is just slightly different in retirement, right? You're not contributing anymore, but you're still thinking about your portfolio the same way, as a thing that should be as big as possible. And that's not wrong exactly. Growth still matters in retirement, but it's incomplete in a way that becomes really dangerous once you start actually drawing on your savings. Because the moment you start withdrawing from a portfolio, something changes about the math, something that most people, honestly, even a lot of financial professionals, kind of underestimate until it bites someone they know. It's called sequence of returns risk, and the basic idea is this. It's not just the average return your portfolio earns over your retirement that matters, it's the order in which those returns show up. Imagine two retirees. Both start with the same amount of money. Both experience the exact same average annual return over a 30-year retirement. But retiree A gets the bad years early, a rough market in year 1, year 2, year 3, and retiree B gets those bad years late, after their portfolio has had decades to grow. Same average return, completely different outcomes. Retiree A can run out of money decades before retiree B, purely because of the timing. And here's why this matters for the ETF conversation specifically. If you're building your retirement portfolio the same way you built your accumulation portfolio, which for a lot of people means just throwing money into a total market index fund and calling it a day, you're actually leaving yourself quite exposed to this sequence risk. Because a total market index fund is built to capture maximum market growth. It is not built to protect you from a catastrophic early drawdown in retirement. The wealthy retirees who seem to have this figured out, they're not abandoning index funds. They're being much more deliberate about which ETFs they hold and why, and that's where this strategy starts. Okay, so here's where I want to get specific. Because I think a lot of financial content kind of gestures at diversification and leaves it there, which is not that useful. What I'm describing isn't just diversification in the traditional sense. It's a layered approach to building a retirement ETF portfolio, where each layer has a distinct job to do. The first layer is what you might call the income foundation. This is ETFs built around dividend-paying stocks, specifically funds that track companies with long, consistent histories of not just paying dividends, but growing them. Things like dividend aristocrat funds or ETFs focused on high-quality dividend growers rather than just high-yield names. And I want to be really clear about the distinction here because it matters a lot. High yield and growing yield are not the same thing. A fund yielding 7 or 8% sounds attractive until you realize that some of those high yields exist precisely because the underlying stock price has fallen significantly, often because the company is struggling. Chasing yield for its own sake is one of the classic traps that catches a lot of retirees off guard. What wealthy retirees tend to gravitate toward instead are dividend growth ETFs. Funds holding companies that might only yield 2.5% or 3% today, but have a 20 or 30-year track record of increasing that dividend annually. Over time, those modest yields turn into something much more substantial relative to the original purchase price. And crucially, the income keeps growing even during years when the market is flat or down. The second layer is the growth engine. And yes, this means equity exposure, real, meaningful equity exposure, not some token allocation. The thing that distinguishes what I'm describing from a very conservative, income-only retirement portfolio is that there's still a genuine commitment to long-term growth. Because, and this is something I think gets lost in a lot of retirement planning conversations, if you retire at 62 or 65, you might have a 30-year portfolio to manage. That's longer than most people's entire working careers. You need growth. Inflation alone will eat you alive without it. But the growth ETFs in this layer tend to be selected with a bit more care than just buying the total market and hoping for the best. Specifically, there's often an emphasis on quality, companies with strong balance sheets, durable earnings, genuine competitive moats. ETFs that track factors like profitability and low debt, rather than just market cap-weighted indexes where the biggest companies automatically get the biggest allocation regardless of fundamentals. Then there's the third layer. This one is maybe the most underrated piece. It's the buffer, and it usually takes the form of bond ETFs, specifically short to intermediate duration, investment-grade funds. Not because bonds are exciting, they're not, but because this layer is doing something really specific. It's providing a reserve of relatively stable assets that you can draw from during years when the equity side of your portfolio is down. Think of it this way. If the market drops 20% in year 2 of your retirement and you need to withdraw money to live on, you do not want to sell your equities at a 20% discount if you can avoid it. That's how you lock in losses and permanently impair your portfolio. But if you have a buffer layer, a pool of bond ETFs that held their value or declined only modestly, you can draw from that instead, leaving your equity ETFs alone to recover, which they usually do if you give them time. This 3-layer structure, income foundation, growth engine, buffer, is the skeleton of what I see working in the portfolios of retirees who genuinely seem to be getting this right. It sounds almost too straightforward when I describe it like that. But the magic, if there is any, is in the execution. Which brings me to something that I think is almost more important than the ETF selection itself. Here's something I find genuinely fascinating about the retirees who make this strategy work well. It's not the ETFs they pick. It's what they do, or more accurately, what they consistently commit to doing after the portfolio is set up. There's a word for it that gets thrown around a lot in financial content: rebalancing. And I think because it sounds a little dry and administrative, A lot of people kind of nod along when they hear it without fully appreciating what it actually accomplishes. Rebalancing at its core is the act of periodically selling whatever has grown the most in your portfolio and using those proceeds to buy whatever has underperformed. And in retirement, this practice becomes almost counterintuitively powerful. Here's why. When your equity ETFs have a great year, let's say they're up 25%, the natural human impulse is to feel great about that and leave things alone. Why would you sell something that's going up? But here's what's actually happening. Your allocation has drifted. What was supposed to be a 60% equity, 30% dividend, 10% bond portfolio is now maybe 75% equity. Your exposure to a market correction has quietly and significantly increased. The disciplined retiree, the one who seems to navigate retirement with this almost infuriating calm, looks at that situation and sees an opportunity. They trim the equity ETFs that have grown. They top up the buffer that's been relatively quiet. They restore the structure of the portfolio that was deliberately designed to manage risk. And in doing so, they're essentially harvesting gains from strong years and using them to replenish the buffer that'll protect them when the next difficult year arrives. It's honestly one of those practices that sounds so basic you almost feel silly talking about it. But the data on how few investors actually do this consistently is kind of staggering. Most people rebalance when they remember to, which is to say, not often enough and rarely in a systematic way. The retirees running this strategy tend to do it on a schedule, annually, at minimum, sometimes quarterly if the market has moved dramatically. One thing worth mentioning here, in retirement accounts, IRAs, 401ks, rebalancing is relatively clean because you're not generating taxable events. In taxable brokerage accounts, you want to think a little more carefully about what you're selling. But even there, the discipline of rebalancing tends to more than pay for itself over time. There's one more piece of this that I want to spend a few minutes on because I think it's maybe the least discussed and honestly one of the most elegant parts of the whole strategy. And it has to do with where exactly you're pulling your spending money from in any given year. A lot of retirees, and this is totally understandable because it feels logical, basically treat their portfolio like a single big pool of money and just withdraw what they need from wherever is convenient. Maybe from whatever account has the most cash sitting in it. Maybe from whatever ETF is easiest to sell. The retirees running the layered strategy tend to be much more intentional about this. They think of their portfolio, the 3 layers we talked about, as a sequencing system for their withdrawals. And the sequencing matters. In a good year for markets, when the equity growth layer is up, they'll typically pull their living expenses partly from any dividends and distributions that have come in organically and supplement from the growth layer if needed, ideally as part of their rebalancing anyway. The buffer layer stays largely untouched during these good years, quietly accumulating and maintaining its value. In a rough year, markets down, equities are struggling, the strategy flips. Living expenses come from the buffer, from those bond ETFs that held their value while everything else was declining. The equity and dividend ETFs are left completely alone to recover. This is the whole point of having that buffer layer in the first place. It's not there because bonds are exciting. It's there so that you have a choice about whether to sell your equities during a downturn. Because being forced to sell in a down market is one of the most reliably damaging things that can happen to a retirement portfolio. What this creates, essentially, is a kind of natural insulation between your standard of living and the short-term mood of the market. And that insulation, that separation between what the market is doing right now and how I'm actually living, is probably the single biggest psychological and practical benefit of running a retirement portfolio this way. I've talked to people who went through 2008 running something close to this structure. And while they were obviously not immune to the anxiety of watching markets fall, nobody is. There was a qualitatively different experience of that period for them versus the retiree who had everything in a single balanced fund and was watching their portfolio value decline in real time with every withdrawal check they wrote. The structured retiree knew, my equities are down, but I don't need to touch them for another year or two at minimum. The market will very likely have recovered by then, and historically, it has. I want to zoom out for a second before we wrap up, because I think there's something about this strategy that goes beyond the mechanics. Something that I find almost more interesting than the portfolio structure itself. There's a lot of research, genuinely fascinating research, on investor behavior and how it affects returns. And one of the consistent findings is that the gap between what a fund returns and what the average investor in that fund actually earns is sometimes enormous. The fund might return 8% annualized over a decade, but the average investor who held it actually captured maybe 5.5% because they were buying more after strong years and panicking and selling during rough patches. The behavior gap, some researchers call it. What I find compelling about the three-layer ETF strategy is that it's not just engineered to deliver better returns, it's engineered to make better behavior easier. When you have a clear structure, this is where my income comes from, this is my growth engine, this is my buffer, the temptation to do something reactive and counterproductive during a market panic is significantly reduced. Not eliminated because we're human beings and market volatility is stressful no matter what, but reduced. You're not just sitting there watching a single number go up and down and trying to decide whether to do something. You have a framework, a set of rules, or at least principles, that tell you, in this kind of market environment, this is what we do. In that kind of environment, this is what we do. And having that framework, having that clarity in advance, is one of the most underrated advantages in long-term investing. I think about it sometimes like the difference between someone who decides to eat healthier and the person who actually does it for years. The person who does it for years usually has some structure around the decision. They've done some meal planning. They've set up their kitchen in a way that makes the right choice easier. They've built a few automatic habits that don't require daily willpower. They've made the good behavior the default rather than the exception. The ETF strategy we've been talking about does something similar for your retirement portfolio. It makes the good behavior, staying invested during downturns, drawing from the right places, rebalancing systematically, structurally easier than the bad behavior. So let's pull this together, because I want to make sure the takeaway is actually useful and not just interesting sounding. The strategy we've been talking about has three core components. A dividend growth foundation that provides rising income over time. A quality-focused equity growth layer that ensures your portfolio keeps pace with inflation and then some over the long arc of retirement. And a buffer layer, intermediate bond ETFs primarily, that gives you something stable to draw from during market downturns without forcing you to sell equities at the worst possible moment. And holding the whole thing together is a consistent rebalancing discipline and a clear sense of which layer you're drawing from and when. None of this is exotic. None of it requires a financial genius or a Bloomberg terminal or real-time market monitoring. It requires some intentionality up front and then a commitment to maintaining the structure over time, which, honestly, is most of what successful retirement investing actually comes down to. Here's the thing I want to leave you with. Retirement, if you've worked toward it for decades, should feel more like arrival than like a new source of financial anxiety. And the difference between the retirees who feel that sense of arrival and the ones who spend their retired years in a constant low-level worry about their money, it usually isn't how much they saved. It's whether their portfolio is structured in a way that makes sense for what retirement actually demands, which is not just growth, but income and resilience and the ability to leave your long-term investments alone, even when the world outside is making a lot of noise. If you're not there yet, If you look at your current portfolio and it's more or less one or two broad funds and a vague plan to figure it out as you go, that's okay. Most people are in that position. But the gap between that and a deliberately structured retirement portfolio is smaller than most people think. And taking the time to close that gap sooner rather than later is one of the more meaningful financial decisions you can make. Not because it guarantees anything, but because it gives you a genuine framework, a structure that's been working quietly for a lot of people who seem, from the outside, to just have this figured out. They're not lucky. They're just structured. Now, if you found this valuable, make sure to comment your thoughts, your strategy. I read every single one. Also, subscribe to the channel and like this video. Thanks for watching, and I will see you in the next video.